Get started. Thanks for joining us today. My name's Eric Daly. I'm with Multnomah Group. Today's presentation, we're going to talk a little bit about the environmental, social, and governance-aware investments and a recently proposed rule by the Department of Labor. So we'll talk a little bit about the framework of what's happening in that marketplace, talk about the regulatory environment, both current and proposed, and hopefully leave you with some additional steps relative how best to manage your own plans in the wake of what's happening. As we get into it, I wanted to start with a few housekeeping items. The first of which is that we're recording today's presentation. So to improve audio quality, we've muted your lines. That said, we enjoy and certainly appreciate any questions that you may have over the course of today's presentation. Feel free to use the Q&A box as part of the meeting program today, and we'd be happy to try and address as many of those questions either as part of the prepared remarks or potentially by following up at the conclusion of today's presentation. We will also be sending out copies of the slides today as well as the recorded presentation. So to the extent that there are other individuals you want to share that information with, we'd be happy to make sure that those are available to you, typically within 3 or 4 business days after the conclusion of today's presentation. So the agenda, as I mentioned earlier, an introduction. I'll talk about myself and my co-presenter, David Williams, today. We'll get into just some of the fundamental language. I think there's some real tricks around understanding how people refer to these specific types of investment products. And I think it's particularly relevant as we talk about the regulatory environment that these investment options are operating within. We'll talk about different approaches and the best case for why you might want to include or exclude ESG investments as part of your defined contribution menu. We'll talk about the fiduciary responsibility issues relative to ESG and how the Department of Labor has modified, changed their perspective on that over the last 25 years. And then we'll talk a little bit in closing about the new proposed fiduciary rule relative to the Department of Labor, and then close it out with some next steps or actions to take as a plan sponsor in fiduciary. So with that, I'll start with just the introduction piece. As I mentioned, my name is Eric Daly. I'm a member of the Multnomah Group's investment committee, consult with a number of defined contribution, defined benefit plan sponsors across the country. I'm joined today by David Williams. David Williams is a chartered financial analyst and is the chair of the firm's investment committee. David's been working for almost the last 2 decades on the retirement plan consulting space and is has a BS or Bachelor of Science from the University of Puget Sound. So with that, maybe I'll start with the basics of sustainable investments. As we talk about today's marketplace, I think ultimately we would break it into 2 different types of investments. Yes, there's fixed income, there's international equity, there's small caps, there's large caps. But just in the context of today's presentation, we're going to talk about ESG themed funds and non-ESG themed funds. So let me start on the non-ESG themed funds, even though that may not seem intuitive based on the context of today's presentation. And so non-ESG themed funds traditionally would be any investment option that doesn't use ESG as a primary criteria for the development of an investment menu. That is not to say that a number of non-ESG themed funds don't utilize some form of review relative ESG type topics. And obviously when we talk about ESG, we're talking traditionally about environmental topics, topics about social justice, and topics about governance and independence. And when we look at those particular, and sustainability, and when we look at those particular pieces, it's not uncommon for an investment manager to review those types of factors as a method to determine how it may impact stock prices going forward. So for instance, if you are a fossil fuel type organization, the pressures on your stock price could potentially come from a number of factors that are driven by the E, or the environmental output of your business operation. Clearly, A, there's a movement away from fossil fuels to more renewable sources, which might cause a reduction in demand for your product, which obviously would have an impact on your stock price. There's the potential for spill or environmental damage, where the courts hold you as the shareholder responsible for cleaning up an environmental crisis. And ultimately, again, that would have an impact on your stock performance. And clearly, there's the opportunity or the possibility or even potential likelihood of environmental regulation, and environmental regulation potentially having an impact on your profitability. However, when we look at non-ESG themed funds, we're looking at the E, the S, and the G as impacts on stock price and performance. And as a result, they may not advertise necessarily their approach, but as you look through their process, they focus on those factors as being material. The same would be true for issues relative governance. The environmental ones may be more straightforward, but on a governance perspective, there continues to be concerns about boards that either lack diversity, that lack control, provide weak oversight of management systems, and what the potential impact on stock performance could be for those organizations as well. Today's presentation is going to be focused primarily, however, on ESG themed funds. And these particular investment products tend to have these ESG type topics as being a core to ultimately how these particular investment options are put together. We're going to talk about really 4 different types of ESG approaches. We'll talk about thematic ESG funds and approaches. We'll talk about kind of responsible ESG investing. We'll talk about screened products. And last but not least, we'll talk about impact-based products as it relates to the ESG marketplace. When we get into these particular issues and topics, the language becomes very, very important because while ESG tends to be looked at as a very broad category and everything from religious themed funds through investment products that screen out fossil fuels or munitions makers all get lumped into a similar category, I think it's really helpful to begin using some of the Department of Labor terminology and the principles of responsible investment documentation to really categorize these products correctly. So I've already talked about the ESG integration, the explicit and systematic inclusion of ESG issues into the investment analysis and investment decisions. The belief that those factors will impact stock price going forward, and therefore having a process by which those factors are considered when making a determination about whether to include a stock or a bond within an investment portfolio. Thematic ESG becomes the topic of then looking for themes that ultimately allow investors to invest in securities or companies that stand to benefit from specific themes, relative environmental, social, or governance factors. Maybe a classic example might be a wind electricity provider or a solar electricity provider that as these thematic approaches begin incorporating in the global marketplace, these types of companies or organizations would expect or likely benefit from a movement away from one type of production to a secondary type of production. We see tremendous interest and review among plan sponsors among what we'll call responsible investment approaches. So these are investment strategies and practices to incorporate environmental, social, and governance factors in investment decisions, and typically involves more active ownership. And by active ownership, I mean as an investor at the mutual fund or the collective level, that you're expecting the investment manager to vote, for instance, company proxies in such a way that continue to encourage stocks, companies to allocate resources and take actions that are consistent with that responsible investment approach. A number of investment products have been available for really decades that we would consider ESG screened, which are approaches that allow investors to exclude entirely types of securities and industries based on specific characteristics. So if you go back 20 or 30 years, that may have been guns and ammunition makers, could be defense contractors, Certainly more recently, the focus has been more heavily focused on environmental issues and the externalities associated with energy production. Any of those screens could be incorporated, one or a multitude, into an investment philosophy or approach. And the last, and the one that we'll talk about a bit today, because it's a specific focus, at least in some of the language from the Department of Labor, is what I'll call impact investing or economically targeted investment, or ETIs, as you look at it across the spectrum. These particular types of investment approaches make specific investments with the intention of generating kind of a measurable, beneficial, and social or environmental impact. So they're making investments with a hope of improving society in addition to obviously accruing an investment return. These particular approaches look at the ETI or the impact investing approach as being a process by which to get an outcome. And only one portion of the outcome is potentially the investment return you may expect to accrue as a participant, a shareholder, a beneficiary in a defined contribution plan. David, maybe you could walk us through some of the issues relative ESG themed funds and how that may play out in a decision about whether to incorporate or not incorporate these types of investment products in investment venues.
Sure. Thanks, Eric. So now that Eric has kind of walked through definitional items with regard to ESG investments, wanted to focus on some of the areas that we would review with a committee or within our internal investment committee as we think about the cases for and or against ESG investments. I mean, first off, this is a highly researched area within the investment world. It's certainly an area that there's a lot of interest from both institutional investors as well as participants. And so, as a result, research tends to follow. So on the left-hand side, we have the case for adding ESG investments into a process. And first and foremost, the idea is that a company that exhibits good performance on sustainability issues will have significant outperformance relative to those companies that have poor performance on those issues. And so this is clearly a reason for considering including ESG into an investment, whether it be a fund or within the process itself that's conducted by the investment manager. Research has found that that banks that have strong corporate social responsibility policies tend to have better performance. So again, kind of along those same lines of entities that are do good end up with good financial performance. On the fund side, so that was really on the company side, why it's good for companies to have good sustainability or corporate governance structures. On the fund side, what research has shown is that performance for non-ESG related mutual funds tends to not have a significant difference in performance for those funds that have ESG related. And there's some cyclicality to that, and you will see from time to time there may be some performance differences, but in general we don't typically see the research has shown that there's not a drag on performance for those funds that offer ESG related themes. And I think one thing that's important on the case for side is particularly with those first two items, good performance. A good company does not make a good investment necessarily, and a bad company does not necessarily make a good investment. I think it's important to know that these are focused on performance from a financial standpoint, and certainly something to you want to incorporate from an investment management process is turning that. Is it a good company? Does that ultimately become a good investment? On the con side or the case against side, I think one of the real things that really over the last 20 years that Eric and I have probably talked multiple times with committees about is if ESG is really truly beneficial to an investor, ultimately, will that get arbitraged? Will others see that aren't coming in at it from a purely social ESG or socially responsible, using a term from days gone by, but will investors just purely profit seeking? Will they utilize those factors and really reduce the benefit of pure ESG investing? And so that's something that research has shown that may be diminished over the years as more investors start to utilize these factors into their process. As Eric talked about on an earlier slide, more of an integrated process for implementing ESG investments. That next bullet, I think, is certainly had an area that we've discussed over the years. Depending on the type of implementation of ESG, there's a possibility of the products, the end result, those portfolios having biases included in them, whether that be capitalization, geography, industry. I know there's a fund that was used for a number of years that tended, based on their criteria, it was a screening fund, it was tracking an index, but that fund, based on the criteria that they had developed, resulted in a lean, a nudge towards the growth side, towards large cap growth, tended to have, based on their criteria, less exposure to energy industrials, which are traditionally more value-oriented securities, and had a higher exposure to technology companies. And so there was some concern about the bias towards growth and so forth. From a performance standpoint, did it lend itself to higher volatility or less volatility, depending on the period that we were in? But it's certainly something to be aware of, that's a possibility based on the criteria of a various investment, in particular investment strategy. And then I think the last point there, what constitutes, essentially the issue here is what is socially responsible, or what factors I would like to express are going to be different than maybe what Eric would like to express versus so on and so forth. And I think this is something that we spend a lot of time with committees that are going down, adding the ESG option or including ESG into their investment menus, is what's the right level of specificity to offer this type of investment option, and be aware of, you are creating an investment menu for your entire population, not necessarily specific individuals. So we move on to the next slide. Looking at some survey data, there certainly is an appetite from a survey perspective. Participants are interested in sustainable investing. A couple of stats here. 70% of participants noted that they are interested in sustainable investing. 80% of participants want to reflect their values into, or want their retirement plan and investment portfolio to reflect their personal values, which I think is something we hear often in committee discussions, and is certainly something that introduces some potential issues around the construction of that investment menu. 70% of participants expect their employer to be aware of sustainability risk within the 401k plan. This is not exactly akin to what we've seen in a lot of higher ed or endowment and foundation investments, that have really, their constituents have really pushed them to look at sustainability issues. And those are different portfolios than we have with retirement plans, but it's certainly something that there's a lot of awareness of sustainability risk and wanting to see that at least acknowledged and somehow implemented within retirement plans is something that's a very critical piece out there. For many of our clients, being West Coast focused and higher ed or research focused, I think it's particularly something that we encounter quite often. And then the last one is, 80% of DC plan investors saying that they would remain in a fund that they were defaulted into or automatically enrolled into that had that incorporated sustainability risk into that. And that's certainly an area, a couple of thoughts on that one. One is the research really shows that participants that are automatically enrolled and defaulted into an investment tend to stay in that investment, take that, what we would call a nudge in the industry, and stay with that investment over a long period of time. They view that the employer has done their research and feels that this is an appropriate investment. And that's particularly true as we go down the age cohorts. Younger individuals tend to follow that nudge even more so than middle-aged and older plan participants. So I think it makes sense to us that that younger cohort may have a higher focus on sustainability and also more comfortable with the automatic nudge associated with auto enrollment. Well, here's a fun chart that we use to think about different approaches for addressing environmental, social, governance themed investments into the investment menu. So if we take a step back, you as committee members have a responsibility for developing an investment menu that meets the needs of your entire population. Many of our clients have taken the approach of creating a tiered investment approach with target date funds, low-cost building block approach on the core funds, and then an extended array that offers its set of actively managed mutual funds. Really with the idea that, similar to this exhibit here, as participants go down those tiers, it increases the complexity of the decision-making process for them. So with respect to kind of overlaying this with the ESG approach, you can have what we would consider three kind of options for including ESG investments into your investment menu. There's the full integration approach. So there, as we talked about earlier, if ESG themed investments are integrated into a mutual fund manager's investment process, then as that manager is doing their analyst team is doing their fundamental research on a company's management, their products, their competitors, they're also going to include in that process sustainability issues, environmental issues, governance issues, where there are social justice issues as well, in ultimately determining is that company and its securities a good investment. So think of that as, for analogous, we have a large cap growth manager who has a multi-step process. If they were fully integrated, then really what they're doing is, as part of that research process, in evaluating a company's ESG criteria, kind of scoring or criteria as part of that process. And so a participant would be investing in a large cap growth fund that also included ESG criteria in its investments. So that's really kind of the full integration piece. The next step down, the addition of themed funds, this is certainly where the vast majority of defined contribution plan sponsors are with regard to ESG options, if they're including them. So they'll add funds that, whether they are potentially actively managed or passively managed, are incorporating ESG themes. They may be segregated from a tier structure and a communication to participants that they are ESG themed, or they may be included alongside other options within that kind of extended array. And then the last one there, the self-directed brokerage window. So plan sponsors that get to the point of wanting to offer a self-directed brokerage window may have decided we've built a menu that meets the needs for, let's say, 95% of our population. We think ultimately that like I said, 95% our needs are met through the other options that are offered, but we want to offer a self-directed brokerage window where those participants can go out and invest in any mutual fund that's publicly available. So there, if a participant ultimately wasn't satisfied with either a full integration process or the slide of themed, or the tranche of themed investments, they would be able to pick any mutual fund that was available with respect to ESG options through that brokerage window. We note, the complexity increases as we go down this for the participant. So, full integration, this is the least complex. And once we get to adding the addition of themed options, and the participant has to choose between passive options, actively managed options, and ESG options to determine how they will utilize ESG. And then the self-directed brokerage window, then you're opening that participant up to 7,000 choices of mutual funds. On the opposite side, moving for the plan sponsor, is you are starting with the lowest complexity on the self-directed brokerage, and then moving up, and largely because as you move into the addition of the themed or the full integration, you're including that in your review and monitoring process for selection and monitoring on an ongoing basis, the inclusion of those ESG concepts into the fund menu, whether they're on a standalone or fully integrated.
Thanks, David. There has been a tremendous amount of what I'll call regulatory guidance over the course of the last 25 years. And the guidance hasn't been either steadily moving in one direction or the other. I think the whole notion here is that it's been a wave of ups and downs for plan sponsors and fiduciaries based on typically Department of Labor guidance, and some of that has been correlated to whoever the political party in charge of the Department of Labor was at the time. I mean, some of the earliest guidance on ESG investing came back in '94, IB 9401, Interpretive Bulletin 9401, which essentially created what has been referred to historically as the everything being equal test. And the everything being equal test was one that said, hey, if you had two investment options and one is an ESG themed and another one is not, and all the risk and return and cost characteristics are similar, then clearly you could use the ESG option as an alternative within your plan. And that stood for over a decade as being kind of the primary test through which ESG was viewed. During this entire period, clearly, we continue to see both A, more interest, back to David's point earlier about participants, and B, more utilization, both on an integrated basis as well as on a themed basis. In 2008, there was an additional interpretive bulletin issued, 2008-1, which added some additional context to the everything being equal test. And by that, I mean, made it clear that they should be taking into account all of the quantitative and qualitative analysis and economic impact. not just, hey, they generally are the same types of investments that should generally generate the same types of returns, but how will adding those ESG criteria impact the expected return of investments and expected risk of investments for participants going forward. 2015 was thought to be some of the most promising guidance. In 2015, the Department of Labor issued Interpretive Bulletin 2015-1, which essentially went back to 9401 and said, disregard or ignore the 2008 guidance. We like the everything being equal test. But the most important part of 2015-1 was it added those ETI type investments. And again, think of those as being the impact investments, where you're not just saying, hey, we want to screen out, we're going to screen out fossil fuel companies from inclusion within the portfolio. And there's some risks associated and potential regulatory risks and cleanup risks and all the other risks that come along with that. I think all of those things were critical and important. But by adding ETIs to the particular piece, I think you've really had a pretty significant impact on how plan sponsors thought they could begin to impact portfolios going forward. That didn't last long. Clearly, as the transition from Department of Labor to Department of Labor occurred over this period of time, that's had a pretty significant impact. Field Assistance Bulletin 2018-1 was very specific about ETIs and discouraging their utilization within plans or those targeted investment or impact investment type products. Certainly heavily discouraged the use of ESG as a criteria within QDIA investments as part of that portfolio. So again, there's been this consistent back and forth relative guidance, which has made it somewhat more problematic, especially for plan sponsors who are more conservative in their approach, not wanting to be at the vanguard of what's occurring within the ESG marketplace. So that really just gets us through the guidance issued by the Department of Labor. I'm going to talk a little bit now about the Department of Labor Proposed Rule, which is, I think, what plan sponsors are focused on now. The Department of Labor has now proposed a rule, published it, seeking comment. And then if you're looking at just getting some context, certainly there's the published remarks of the current Labor Secretary, Scalia, as well as from a number of regulators on the Department of Labor side, if you've had a chance to attend some of the conferences recently. And the comment in the proposed rule essentially is that private employer-sponsored retirement plans are not vehicles for furthering social goals or policy objectives. I think that speaks a little bit directly to that notion of targeted or target impact investments, ETIs, that we talked about earlier, that are not in the financial interest of the plan. So there is a critical difference, at least in the comments, relative the notion of having investments whose primary purpose is to drive returns and incorporate those factors in helping make a determination, versus those potential investments that have as a secondary or at least shared primary goal of using assets to try and further, again, those social or policy objectives that an investor may have as they exercise those rights. And looking at the proposed rule, it essentially says that plans should select investments based on financial considerations and on a risk-adjusted economic value basis, and that ESG factors can be pecuniary factors only, and I had to look up pecuniary a multitude of times, but ultimately meaning that it had to be focused on investment return. And that's the important part from a fiduciary perspective, which I think, if you look just at the verbiage and language, is not inconsistent with, I think, most approaches. The notion that these ESG criteria, if they are both, back to David's point, not negative to returns, but also potentially have a positive impact relative the risk factors associated with those organizations potentially, or the opportunity for return as the behavior of global citizens changes over time, that would be important. I think it's really important to point out that the proposed rule is just that, a proposed rule. It is not in final form. It is not the rule. And there is a tremendous amount of political pressure relative to this specific issue. I had the opportunity this morning to participate in a call where the chairman of the Education and Labor Committee in the House, Congressman Burt Scott from Virginia, was speaking. And this particular issue, in addition to some issues relative to the fiduciary rule, are very front and center relative the Health Committee and their belief that the guidance that is being driven under the Department of Labor proposed rule may not be consistent with better outcomes and doesn't seem to be well supported based on some of the data that David shared earlier. I think that's been echoed by Senator Patty Murray on the Senate side, again, who has been very critical of the Department of Labor rule, or at least the proposed rule, relative ESG investments. That said, I think it is really clear, at least now, that this is both an area of debate in the marketplace, as well as an area of review. So while you have the Department of Labor's proposed rule out, you've got pressure both from Congress as well, from the House as well as the Senate relative to the proposed rule. I think what's also interesting is I got a copy this morning of a Department of Labor request for information letter to a client. And this is a client where the request for information was focused exclusively on their ESG themed investments. And this is not atypical. Other times when the Department of Labor is trying to come up with a regulatory pattern and or establishing rules or interpretive bulletins, they will collect data from plan sponsors to try and assess how actively or efficiently or well plan sponsors are currently complying with existing regulations. I think it was interesting, certainly in the data request letter that we had an opportunity to review, that they were specifically referring back to the 2018 guidance and trying to get a better sense of how committees are making decisions. So if you look at the actual letter itself, what they were requesting is essentially copies of minutes from meetings where ESG themed investment options were discussed. They wanted some data about how they were selected and being monitored, how they were being communicated to participants. So it's a relatively long stretch of data, and it'll be interesting to see how broad the Department of Labor's information collection effort is in this regard. But it's certainly the first time, literally this morning, that we've seen data that supports that the Department of Labor is doing much more than providing guidance on this issue. It appears that they have some real interest in trying to both finalize, obviously, the Department of Labor proposed rule, but then also make a determination as to whether this should or should not be an area of enforcement influence over the course of the next several years. Kind of with that background and framework, David, maybe I'll hand it back to you to talk a little bit about what plan sponsors should be considering as they look at their own plans, either plans that have ESG, which again, is not entirely uncommon. And for those that may be considering it based on either some of the feedback today or inquiries that they're receiving from participants.
So yeah, so kind of the action-oriented piece here, next steps. I think first and foremost, we would strongly recommend that the criteria that you use to review ESG themed funds be the same as their core equivalents. So if you are, using a large cap, let's call it a large cap blend U.S. equity fund, we're comparing that that ESG large cap core fund against the S&P 500. We're going to compare a non-ESG themed against the S&P 500 as well, and use the same performance criteria, expense criteria, same measures for both the ESG themed fund as a non-ESG themed fund. We think they should stand. There shouldn't be a discount offered for an ESG themed fund. We, based on you know, the proposed rule in past as well, you know, we're very wary of ESG themed funds being included in the QDIA, or the qualified default investment alternative. So for your ERISA qualified plans, if you're defaulting a participant into an option, we would strongly suggest that probably doesn't have an ESG themed component to it. If participants want to choose ESG themed options, then that would be something that they would choose to do, as opposed to being the default approach that a plan sponsor may take, or the committee would take. And then finally, you know, based on Eric's comment on the document, the information request they reviewed this morning, we think it's really important that you document in the investment policy statement the approach that the employer or the plan sponsor has taken with regard to ESG investment options. So both from a monitoring and a selection basis, that be included within the investment policy statement, and that you are conducting regular monitoring of those investment options along with the rest of the investment options offered in the plan, and that gets documented within your meeting minutes, so you have that documented trail of due diligence that you as a committee have taken on behalf of you're fulfilling your fiduciary responsibilities.
That's an interesting environment that we're clearly operating in. I think, regrettably, that, like so many things in society right now, this appears to be very polarizing from a political perspective, and it's creating a great deal of uncertainty, regrettably, in the beginning. I do think that, clearly, given where guidance is leaning at this particular point in time in the proposed rule, the argument of we should have ESG because participants like it is not a very effective argument, and one that potentially carries some risk. So having a policy document that outlines significantly some of the economic benefits, and making sure that you're calculating and evaluating risk-adjusted returns in a way that is consistent with other approaches, is going to be the best method by which to relieve or alleviate some of the concerns relative to the guidance on ESG at this particular point in time. That's going to be a critical piece, and then obviously we'll see as this hacks its way through both the Department of Labor and Congress, and some of the audit action from the EBSA, how that plays itself out over an extended period of time. So with that, we happy to open it up for questions, feedback, concerns relative to the ESG marketplace, and what we've shared or gone through with y'all today. This is the awkward silence while David and I sit, either because you guys are typing out messages and/or because you're in the process of logging back out of one of his maybe several Zoom meetings that you're attending today. I am going to, as I do typically in committee meetings, take silence as acceptance, and want to thank you very much for attending today. Again, happy to share the information with you. We'll be sharing these materials as well as the recorded presentation, so be looking for those in your email inboxes, and feel free to share as you deem appropriate. Thanks for your time today.